good, family? So today I'm going to compare two stocks, and at the end of the video we're gonna say which one would Trap pick. Now, we've been reading the chats, we've been reading the comments. That's why we tell y'all put them below so we can serve y'all what y'all want and not what we want. And so we saw that y'all really like when we do the comparison, so that's what we're gonna do. And we're gonna break down the comparison so you know like what's the details that you're looking at when you're looking at a company. That way you can use this blueprint if you're a new beginner to say, okay, I can see how this look. Let me go right here, right? So I want you to use this as an exercise, do your own comparisons, and tell me in the chat what you came up with. So before we get into it, man, let's like, let's subscribe. Also, man, let's share this, man. And so let's get into it. So today we're gonna compare two companies that I like. One is Fastenal. It's definitely been a sleeper. It's one I've been rocking with since before the pandemic. I put a lot of people on this. It's in the construction industry. It will be in the industrials sector of the market. So when I was working ironwork, building stadiums, building power plants, I noticed that all of our nuts, our bolts, our screws, they would come from this company called Fastenal. Even our fork, not our forklift, our scissor lifts, when you get in, they go up and down. All that was created by a company called Fastenal, which is this company right here, F-A-S-T. And we're gonna compare them to a company called Grainger. Now, Grainger was the company that we got a lot of our industrial tools from. So if you wanted to get your tools, if you're in construction, you already know about Grainger. And so I want to compare these two companies because while everybody is going for the high-flying technology companies, little do we know that inside of that industrial sectors, outside of Caterpillar and Boeing, there's some certified bangers. And so today I want to put you on. So first, ticker symbol F-A-S-T for Fastenal, ticker symbol for Grainger, GWW. As of right now, Grainger is $1,007. As of right now, Fastenal is $77. Now, what I want you to understand that is when we're looking at price, when we're looking at the market, we got to associate price with value. We got to associate price with value. That's how we know if something is expensive or it's not expensive. So off the flip, we're going to look at the market cap, which is the stock price times the outstanding shares. So the shares that you buy when you're buying a share of a stock, it has to come from a pool of stocks that the company has called outstanding shares. These are the shares that me and you buy. So if you multiply this number, the stock price times how many outstanding shares they have, you'll get the market cap. So right now, Grainger has a bigger market cap at $49 billion compared to Fastenal's $44 billion. So Grainger has the bigger market cap. So we'll just put a green by that. We'll just put a green by that. All right, next we're gonna look at the PE ratio, which is called price to earnings. This tells us how much we're paying for $1 of the company's earnings or the company's profit, right? And this is one of the ways you can tell if a stock is expensive or not. So right now, Grainger has a 28 PE ratio and Fastenal has a 38 PE ratio. So that tells us right now that Grainger costs cheaper than Fastenal. We're paying $38 for $1 of Fastenal's profit, while with Grainger we're paying $28 for $1 of Fastenal's profit. That's what I mean for Grainger's profit. Excuse my handwriting, y'all know I ain't got the best handwriting in the world. I just know how to count money, you hear me? So as of right now, we see Grainger has the bigger market cap. Grainger is actually cheaper when I want y'all to really get this, because a lot of times y'all look at stock price and say, yo, that's expensive. Well, this is how you compare value to price. Based on the PE ratio, price to earnings, meaning the price I'm paying for $1 of earnings for this company, you're paying $28 for $38. That is super, super, super important. So that was gonna go to Grainger too. Grainger is a little cheaper. Now, when it comes to debt, right? Grainger has $2 billion in debt, while Fastenal has $260 million in debt. That's sweet. So that tells us that Fastenal management is doing a good job at managing that debt. We like that. Next, we're gonna go with free cash flow. Now, this is important because this tells us, this is one of the most important metrics for me when I'm looking at a company, because after the company pays everything, this free cash flow is where your dividends come from, or it can go from retained earnings, but this is where your dividends coming from. This is where the company uses to acquire other businesses. This is where the company can even use some money to do some share buybacks. So this is really good. And as a company is paying down debt, the company free cash flow increases. So if we look at the free cash flow, Fastenal has $1.2 billion in free cash flow, while Grainger has $1.5 billion in free cash flow. And so we got to get this onto Grainger. We got to get this on the Grainger. Now, let's talk about the dividends, because your dividends actually come from the free cash flow. So every time a company pays dividends, they got to go to the board of directors. They make a vote and say, yo, we can increase this dividend. That dividend will come from the free cash flow. All right, so when we talk about free cash flow, we talk about dividends. So Fastenal pays a 2% dividend, and it comes out to be $1.56 annually, while Grainger pays a 0.72, less than a percent dividend, but it pays $7. Now, I like that, because when we looking at percentage, when we looking at dividends, you can be the type of person that looks at dollar amount, and you can be the type of person that looks at percentage. Either way is not really wrong. Because you can look at a company like ATT, they pay a 7% dividend, it's kind of like $2 and something, right? So I'm gonna be real with you, I'm the person, I look at both of them, because I want a dividend that can be more than 2%, but I also like the $7 dividend. I'm gonna let y'all make the decision, but for me personally, I'm gonna go here. But I'm not mad at the people that say give me a $1.56 dividend, because I also like Costco dividend. It's a huge dividend, but the percentage is low. So it just depends on how you looking at it. I'm gonna let you make the call. Me personally, I'm gonna definitely go with this, but I'm not mad at this at all either. That $1.56, and I'm not mad at that, whereas they paying us $7 a year. So I'm not mad at you for making either one of those, but just based on me, I like this. Now, again, I'm unorthodox. I'm not part of the traditional investing, because people be like, well, look at this low percentage ratio that's getting eaten up by inflation. Man, that's $7 and that's $2. That's $7 and that's $1.56. If I ask you if you want $7 or $1.56, which one you gonna tell me? You ain't gonna tell me nothing about no inflation. You feel what I'm saying? So, but a lot of people, when you follow the investing books, they gonna say, percentage, and, of course, Grainger can increase that because we see they got the money. I would love to see them increase that, but I'll go with Grainger right there. Right here we got revenue. So revenue is all the money coming in from business. So we see that Fastenal has $7 billion in revenue coming in, whereas Grainger has $4 billion. So Fastenal is doing a great job at generating revenue. Now, they're not doing bad when we think about it. Let's think about it. $49 billion in market cap, $44 billion in market cap, which is $5 billion differential, but we see $3.7 billion almost differential in revenue. And now this makes, even though that's big, this makes more sense too, because you're a bigger company, right? And you have more free cash flow, but I'm generating more revenue. And so now that $1.2 billion actually is not bad. It's really good when you put them side by side like that. Right? When you put them side by side like that, like, yo, you $5 billion more than me, but you're only, a couple $100 million more than me when it comes to that. So I'm not really, if that makes sense? Like you can actually give this to Fastenal because they're a smaller company, but if we just gonna do it on dollar amount, we definitely, matter of fact, I gotta give it to Fastenal with that. I'm not gonna lie, because they're a smaller company and they generate more revenue. I got to get that to Fastenal. I'm not going to lie. Smaller company, generate more revenue, right? Pay a percentage-wise, paying a bigger dividend, and it has $1.2 billion. I'm going to have to get that to them. I got to. Now, this is really good right here. So this is called net margin. So the net margin comes to you as a percentage. I'm gonna put it like this: what percentage of the revenue equals a profit? Simple. I'm not gonna get into all the technicality. That's how people be losing people. What percentage of the profit? What percentage of the revenue? So net margin. Watch this. Fastenal, 11.5% of their profit. 11.5% of their revenue is profit, right? Whereas with Grainger, 11.1% of their revenue is profit. Now, let me tell you something about that. Both of these are really good because anything under 10 is considered low, 5 is considered bad, 20 or above is considered outstanding. So both of these companies have an 11% net margin, which is good. But that's what makes this look so much better, y'all. Right? That's what makes this look so much better. Now, of course, again, if y'all ask if you wanted to have 1.5 billion, if you wanted to have 1.2 billion, you're going to say, I want to have 1.5. But when we looking at the business, how big this business is. This is a $44 billion market cap, $49 billion market cap. It is more expensive. They do have less debt. If they pay some of this $2.2 billion debt down, that'd be different as well. All right, so this is another amazing thing right here. Return on invested capital. So this telling me if they put $1 out, what they can get back from that. So theirs is, for every $1 they put out, this is what they saying to get back. So you look at this, they're getting 30.3, and their return on invested capital is 33.3. No matter what, you got to give it to this because we talking percents right here. You got to give it something to that. It's not big. It's not big, but we talking numbers, 3%, man. I need that 3%. I need my 3%. So we like that. Let's do a recap. So we see Grainger has the biggest market cap. We see that Grainger is actually cheaper. We see that Fastenal has less debt. We do see that Grainger has more free cash flow, but compared on how big they are and compared to the revenue and the net profit, we see that Fastenal has a better free cash flow sitting on. Grainger actually, for me, percentage-wise, this is better, but I like the $7 dividend just myself. Fastenal brings in more revenue, but remember that revenue doesn't always equal profit. That's why this one is so important because we see that 11% of their revenue is profit. 11% of their revenue is profit, which is good. Then we see Grainger has the bigger ROIC, means that not by that much. But that 30 and that 33, that means they both are generating great money. They both have great balance sheets. They both have great brands. That's why I use this. I wanted you all to see that companies that aren't in the tech industry can also be colossal. They can be behemoths. But here's where it go at right here. 5 years, Grainger returned 245%. In 5 years, Fastenal returned 149%. So they almost double what they return, y'all. That's crazy. Woo! That's crazy right there, man. So I would have to get this one. On a percent basis, we gotta give it to Grainger. Gotta give it to Grainger. So I'm not gonna buck the numbers. Let me see in the chat before I say it which one you will go with. Before I say it, let me see in the chat which one you will go with. Even though I own this one, I don't own Grainger. Just being realistic, Grainger would be the better return on your money, man. 245%, 33%. You know what I'm saying? It is cheaper when it comes to price, but you can't slip. It's a toss-up. You can't slip, man. You're talking about less debt, which is always good, but it's a bigger company. Less debt. A lot free cash flow, dividend is solid, bringing in revenue, great net margin, sweet return on invested capital, and 149% is elite status, man. So, man, I would go with Grainger, but I own Fastenal, but I'm not gonna be biased. You know what I'm saying? I feel like you can look at this. I feel like you can't go wrong with either one. It's just what you know what I'm saying? If you want to drop a band on it, cool. If you want to drop $77, I ain't mad at that either. You know what I'm saying? If I was to try to get this, I would probably get it somewhere around, $850 if I could. You know what I'm saying? Anywhere between $850 and $900. If I can get this, it'd be somewhere, I've been owning it for a long time, but anywhere between, I don't know, $70 and $65 will probably be sweet for me, man. So I hope y'all enjoyed this video. Let me know in the chat if y'all liked, if y'all want to see more of these. We got a lot of these, man. Listen, make sure you tune in each and every Tuesday, 7 p.m. on the Wall Street Looks Like Us Now network. It's called Trapping Tuesdays. We want to see y'all there, man. Just the dopest show on the block. Nobody talks about stocks the way we do. We give a complete market analysis on what's been happening in the last week. You get a little bit of that financial Holy Ghost. You get a little bit of this, a little bit of that, man. So it's your boy, the Wall Street Trapper. And make sure you download it on all podcast platforms. Let's go, man. It's your boy, the Wall Street Trapper. Salute.